thank you very much for taking the time to listen to the presentation. I'll give you a very high-level overview of the company, share structure, and then moving on to the value proposition at the end. Just note that we'll be making some forward-looking statements during today's presentation. What Millennial is trying to do is build a multi-million ounce, multi-asset production company. And what we're really focused on, and part of the key asset when we're selecting assets, is focusing on near-surface heap leachable ounces that had clear visibility to 1 million ounces of oxides. And one of the key metrics is why we selected this is we wanted to have a low cost per discoverable ounce and low capex to put these into production. As we're very cognizant of shareholder dilution, and as one of the largest shareholders, I don't want to get diluted to oblivion. To put that into perspective, when you're looking at orogenic systems, it commonly costs around $40 million to put up 1 million ounces on the board. For these types of systems, you're looking at $5 to $7 million. CapEx numbers are extremely low, around 100, 120, as opposed to $500 million. What do you really get with Millennial at the end of the day? You get a team who's put up over 59 million ounces of discoveries, and I think one of the key metrics to that is it's across 7 projects, 5 of which are in construction and production today. You get a compliant 43-101 resource with 1.2 million ounces of oxide. That's supposed to be between Wildcat and Mountain View. You get a strong cash balance of over $20 million. Very aggressive drill program with 20,000 meters going across Mountain View, Wildcat, and Red Canyon. One of the things is think about Wildcat and Mountain View as its own entity. They will be a combined PEA at the end of the third quarter, so it'll have its own pits, pads, ponds, and then you would be trucking the loaded carbon from Mountain View to Wildcat. Red Canyon is a very exciting drill bit story that's right in the heart of the Battle Mountain Eureka Trend. It's 35 kilometers south of the Cortez complex, which is one of the richest complexes in Nevada. It sits in the same rocks, which is the Wenban Formation. It has the same age of mineralization as Cortez, around 32 million years, so Eocene in age. And like I mentioned, a very catalyst-rich story led by the drill bit. The team, you've just met Ruben Padilla from Sable Resources, Terry Harbert. Michael Leskovic runs a fund in Toronto, Northfield Capital. Sarah Heston is a business professor at Stanford Business School, and Eric Tremblay is with Dalradian. He was the general manager of Canadian Malartic, which is now Canada's largest gold mine. I myself, I started off at Côté Gold, which is put the first holes into that in 2009. We subsequently sold it to IAMGOLD for $680 million. It is now Canada's third largest gold project. From there, I was with IAMGOLD and then joined the Talisker Group with Ruben, we did all the technical due diligence for all those Cisco-related companies. Quickly, from a share structure point of view, I think the track record of our team speaks to this slide exactly. And commonly, you would never see names like Merck or Vescor or Franklin Templeton or Century. These are $20 billion Canadian pension funds that would never come sub $100 million market cap. And the reason why they do is because what we've done in the past. I myself, I'm a 34-year-old geologist. It's not like I was running a hedge fund before. I'm the largest shareholder other than Eric Sprott. I put over $500,000 of my own money into this company. So at my age, I'm not Richard Warwick. I can't write $125 million checks into my company, but this is a substantial portion of my cash. Right now, as I mentioned, we've been trading. This is a brand new story. None of these assets have been in the public markets for over a decade. Red Canyon has never been. So a very fresh story. We went public at 50 cents. We did a $24 million financing, sub-receipt financing in January 2021 of this year. What these analysts are modeling, Stifel and 8 Capital, is really a combined NAV of over $350 million US. So, to put that in perspective, when you do a PEA, you usually get about 60% of your total NAV, which gives you these target prices. I think it's very important as we build our brand as Millennial. And frankly, as we attract the next generation of mining investors and build the next generation of mining entrepreneurs, to be very cognizant of the environment we work in. There's been some bad actors in our space, but I think I like to say that my generation, the millennial generation, thinks the eggs come from the fridge, so to speak, and they don't understand that mining is a key pillar to our society, and that it can be done in an environmentally and socially sustainable way. And that's a passion project that I want to educate not only mining entrepreneurs, but the next generation of mining investors, that this can be done in a sustainable manner. Really, in a nutshell, this slide says everything about the company. People don't show this slide because it doesn't look so good for many companies. What you're looking at here is the grade to strip ratio. So when you look at open pit oxide projects, this is the key metric to look at it because it gets the effective grade of the deposit. And when you do that, Millennial has the highest grade open pit oxide project in Nevada. And Nevada being the best mining jurisdiction in the world under the Fraser Institute. Nevada would be, if it was its own country, it's the 5th largest gold producer in the world. So one of the most well-endowed pieces of the Earth's crust. And like I said, people think grade is king. Unfortunately, it is not. The strip and the recovery has a big factor into the economics. So to put in perspective, people think the railroad asset is a high-grade asset that sits at 0.86. When you factor in the strip, it actually sits at 0.28. So as I mentioned, Millennial is the highest open pit oxide project in the best mining jurisdiction in the world. I'm sure a lot of people have seen this slide today. Companies like using it, especially the EV to total resource slide, so they could show how cheap they are to their peer group. The reality is that why they trade at a discount is because the ounces aren't quality ounces. As I just described to you, these are the highest quality ounces in the top mining jurisdiction in the world and deserve a premium. Since we've only been trading since May, it's a brand new story. So I think there's a significant re-rating opportunity on the current resource base alone to trade in line with your peer group at $60 to $70 on an EV ounce basis. Where we see the next resource coming is around 1.5 to 2 million ounces of oxide. So significantly growing the resource base, doing a lot of the resource conversion, and I think you'll really see that as we tie it up with a pretty little bow for the PEA. And like I said, you usually trade 60% to the total NAV of your PEA, so that would be around a $250 million company. And we're a catalyst-rich story with a very tight float, so it doesn't take much to move this thing. There's only 25% float on this thing, but a very drill bit heavy story with basically drill results consistently coming from Mountain View, then Red Canyon, then Wildcat. You'll get an updated resource at the end of the second quarter, which we're guiding in 1.5 to 2 million ounces of oxide, and then the PEA at the end of the third quarter. And just in summary, you get a very well-diversified portfolio of assets. Basically, you're only paying for Wildcat and Mountain View. The rest of the portfolio is basically your optionality and your free carry. You get instant ounces in the best jurisdiction. You get a significant institutional shareholder base and insiders like myself and Ruben and Jason, who are here today, putting in money consistently, and really a nice re-rating opportunity once the PEA is out. Thank you very much.